Is D-Wave Quantum Inc. an undervalued hidden gem of the AI and quantum computing revolution? Or, is it just a classic value trap waiting to catch unsuspecting retail traders?
That is literally the billion-dollar question right there.
Right. And that's exactly what we're tackling today. Welcome to the deep dive, everyone. Before we really get into the weeds here, please take a second to like the video, subscribe to our YouTube channel, and definitely leave your feedback in the comments. We want to hear what you think.
And just a quick reminder for everyone listening, we're just having a natural debate about the data here. Nothing in this deep dive is financial advice.
Exactly. Do your own research. So let's set the scene. We are looking at a massive central paradox with D-Wave, ticker symbol QBTS. As of yesterday, which is April 21st, 2026, the stock closed at $20.36.
Which means it was down about 6% for the day.
Yeah, and down roughly 15% year to date. But, and this is the wild part, just back in mid-April, this exact same stock saw a massive 52% surge, all on the back of NVIDIA's quantum AI tool announcements.
It's giving retail investors absolute whiplash. I mean, you have this NVIDIA news that acted as a massive catalyst, right? It brought this huge wave of institutional and retail eyes to a company trying to build, the infrastructure of tomorrow.
But then reality hits.
Exactly. As we can see with that year-to-date slump, the daily market reality is aggressively reasserting itself.
Okay, let's unpack this. Because right now, looking at the stock, it feels like looking at two completely different companies. On one hand, you've got the press release version, standing into the bright lights of an NVIDIA partnership, looking like the obvious future of computing.
Yeah, the flashy version.
Right. It's like a flashy sports car that looks amazing in the showroom. But then you look a little closer at the underlying trend and you realize, wait, is this thing secretly leaking oil in my driveway?
That's a great way to put it. You can't just judge a car by its paint job. We need to look straight at the engine.
The financials.
Financials, exactly. That is where the friction is. There's this huge gap between the technological narrative and the actual financial reality. I mean, when you look at D-Wave's income statement for fiscal year 2025, the growth numbers are staggering, but the costs are, well, they're even heavier.
Yeah, let's talk about those numbers for a second.
Yeah.
For FY 2025, total revenue was $24.59 million. That is a 178.5% year-over-year increase.
Which is huge.
It is. Any company growing their top line by nearly 180% is doing something right. They're finding a market.
Huh.
But then we drop down to the bottom line.
And it gets ugly.
Very. The net loss widened staggeringly. They posted a net loss of negative $355.06 million. Yeah, far worse than the previous year's loss of negative $143.88 million. And the trailing 12 months earnings per share is sitting at negative $1.11.
Right. It is a truly aggressive burn rate. Though, to be fair, we should note their Q4 GAAP gross margin did improve to 64.8%.
Okay, wait. Explain that gross margin improvement for a second. Because if they're losing $355 million, why does a 64% gross margin even matter?
Because gross margin tells you about the core economics of the actual product, right? Stripped away from all the corporate overhead and massive research costs. A 64.8% margin means that for every dollar of quantum computing access they sell, it only costs them about 35 cents to actually deliver it.
Oh, I see.
Yeah, so the core product is fundamentally profitable. The reason they're losing $355 million overall is because they are just plowing unimaginable amounts of cash into R&D to stay ahead in a frontier industry.
Okay, but this is where the balance sheet totally confuses me. They ended 2025 sitting on an absolute mountain of cash, like $884.5 million.
A huge war chest.
Right, giving them a current ratio of over 40. Now, usually a current ratio of like 1.5 or 2 means a company's in pretty good short-term health. Over 40 means their short-term liquidity is completely off the charts.
Yeah.
So how can a company with a negative $355 million net loss boast a liquidity ratio over 40? That feels contradictory.
Well, what's fascinating here is you have to look at the velocity of the spending. Don't let that cash pile fool you. Yes, an $884 million war chest looks incredibly secure today. But if their free cash flow is bleeding out at negative $54.9 million, and analysts project they'll be cash flow negative until at least 2028.
That pile is going to vanish.
Exactly. It's going to drain rapidly. That 40x liquidity ratio is just a snapshot in time. It's the fuel they raised to get to 2030, but they are burning it at a ferocious pace. Having high liquidity today absolutely does not equal a fundamentally sustainable business tomorrow.
So they are essentially in a race against their own bank account. They have to achieve massive commercial scale before that money runs dry.
Spot on.
And since fundamental profitability is literally years away, the market is having a really, really hard time figuring out how to price the stock today. I mean, look at the 52-week range. It's wildly volatile, swinging from $5.97 all the way up to $46.75.
And it trades with heavy volume, too. We are looking at a 10-day average volume of around 27.8 million shares.
That's a lot of action.
A ton of liquidity in the stock itself. Traders are actively debating its value every single minute of the day.
So if the fundamentals are totally disconnected from immediate profits, how is the market actually digesting that uncertainty? Let's look at the technical momentum. Where are we on the charts?
Well, since fundamental profitability is years away, we really do have to look at how traders are pricing in that reality right now. And the technicals are flashing a deeply fractured momentum.
How so?
If you look at the one-day core indicators, the relative strength index, the RSI, is sitting dead neutral at 51.5.
But it was a neutral recently, right?
No, not at all. During that NVIDIA peak, it flashed overbought, sitting way up at 70.1. And now we have a MAN CD showing a buy signal at 0.588. But shorter-term models just flip to sell.
It feels like the indicators just can't make up their mind.
Because the market participants can't make up their mind. You see this vividly when you look at the moving averages. The stock is at $20.36. That is below the short-term 5-day moving average of 21.16. And it is also below the long-term 200-day moving average of 22.50. So you have short-term and long-term weakness. But it's sitting above the 50-day moving average of 19.08.
Meaning medium-term strength is still holding up the floor.
Exactly.
So what does this all mean for the average person looking at the chart?
Well, immediate resistance is up at 21.38 and 22.40. Strong support sits in a pocket between 1926 and 1981.
It's like a runner who just sprinted way too fast off the starting line during that NVIDIA hype and is now showing signs of short-term exhaustion. You know, especially seeing that recent break below $21 and the failed crossover of the 3 to 10-day moving averages.
That analogy is perfect. The clash between those moving averages perfectly illustrates the war between momentum day traders and long-term trend investors.
It's a literal tug of war.
It really is. And when the charts show exhaustion like this, we have to follow the money. We need to contrast Wall Street's opinions with what insiders are actually doing with their own cash.
Oh, this is where the story gets really twisted. So let's look at Wall Street first. The consensus rating on D-Wave is overwhelmingly bullish. We're talking a moderate to strong buy consensus. 94% of analysts are in the buy camp.
Which is massive.
Yeah. Average price targets are sitting between $35.53 and $38.18, with highs of $45.
Right, although Zacks research remains a pretty stark outlier. They have a number 5 strong sell rank on it.
True, but overall, Wall Street is saying this $20 stock is going to nearly double. But here is where it gets really interesting. If 94% of analysts are screaming buy, why are the CEO and the CFO actively selling their shares?
The insider activity. It's a huge red flag for a lot of people.
Over the last 90 days, there has been significant insider net selling, totaling roughly negative $262,000. CEO Alan Barat sold shares at $28.06 in January and at $30.13 in December.
And the CFO is selling too, right?
Yeah, CFO John Markovich made multiple sales between $17.63 and $28.06 in the first quarter of 2026. Now, insiders do still own about 10.48% of the company, but they are taking chips off the table.
If we connect this to the bigger picture, you have to look at the order flow. Short interest remains really high at 12.47%.
Even though it dropped slightly recently. Right?
Yeah, down about 2.4%, but 12.47 is still heavy. Look, while insider selling isn't always malicious people buy houses, pay taxes combining executive sell-offs with a hefty short interest reveals deep skepticism from the smart money.
It completely contradicts the rosy analyst targets.
Exactly. The insiders and the hedge funds seem to see a ceiling that Wall Street analysts are just ignoring.
Which brings us to the ultimate question for you, the listener. This massive divide leads us to ask, is QBTS truly an undervalued opportunity, or is it a classic value trap?
There are strong arguments for both. Let's start with the undervalued argument. If you run a discounted cash flow model, a DCF, It pegs the intrinsic value of the company at $58.99.
Wait, $58.99? That's nearly 3 times the current price.
Right, but that model is pricing in the 2030 plus potential of quantum computing. If you believe they capture the market in 5 years, the stock looks incredibly cheap today.
Okay, but then we have the value trap argument. Investing Pro flags the stock as overvalued anywhere above $29. And the reasoning is terrifying. They have a price-to-sales ratio above 200 and an extreme enterprise value-to-revenue ratio near 280x.
Those multiples are where retail traders get absolutely crushed.
Are people buying a business or a lottery ticket here? Like, are they buying a $20 stock based on 2026 realities or a $58 stock based on a 2030 science fiction dream?
This is exactly why retail traders get trapped. A stock looks quote-unquote cheap at $20 because it used to be $46.75, but with an enterprise value 280 times its revenue.
It's just math at that point.
Exactly. Let's put that 280x ratio into perspective. Imagine buying a local coffee shop that brings in $100,000 a year in revenue.
Okay, 100 grand.
If you buy that business at a 280x multiple, you are paying $28 million for a coffee shop that only makes $100,000 a year.
Wow. Yeah, when you put it like that, it sounds completely insane.
The underlying math just does not support the bargain narrative.
And that opens the door to massive downside risks, extreme volatility, dilution risks because they're going to need more cash eventually, and execution risks, which we already saw evidenced by their Q4 revenue and EPS misses.
Right. So to make sense of all this noise, let's clearly lay out the absolute best case and worst case scenarios from here, the bull versus the bear case.
Let's hear the bull case first. Best case recovery.
The long-term upside is monumental. The bookings momentum is frankly undeniable. Q1 2026 bookings hit $32 million.
Which, wait, that exceeded the entirety of 2025's revenue.
Exactly. Combine that with NVIDIA's CUDA-Q adoption and the fact that D-Wave is the only company pursuing both annealing and gate model quantum computers.
Yeah.
The long-term outlook is highly disruptive. They have a serious moat.
But then there's the bear case. The worst case continuation lower.
Yeah, the short-term outlook is just plagued by the profitability lag. Like we said, negative cash flow until at least 2028 or 2030. They missed Q4 estimates. If the momentum fails and that high premium collapses, it could test much lower support levels.
So I have to ask you, the listener, directly, which timeline are you playing? The short-term technicals or the long-term quantum revolution?
This raises an important question about market timing. Being right about the future of quantum technology does not necessarily mean you are right about the stock's price today.
That is such a crucial point. So just to recap this intense tug-of-war we've been looking at, we have a company with revolutionary tech, massive Q1 bookings, and a huge cash pile, battling against extreme valuations, heavy insider selling, and short-term technical exhaustion.
It really is the ultimate battleground stock right now.
It is. Well, before we wrap up, I want to remind you once again to like this video, subscribe to the YouTube channel, and drop your thoughts in the comments. We want to know if you're buying the hype or staying far away. And remember, this was just an educational debate, definitely not financial advice.
Do your own diligence, always.
Absolutely. I'll leave you with a final provocative thought. With Q1 2026 earnings expectations dropping very soon on May 7th and the stock teetering right on the edge of its moving averages, are we about to witness a monumental quantum leap in value, or just another painful lesson in the dangers of catching a falling knife? Keep your eyes on the tape.